Welcome to the Tim Booker Book Sharing channel. Like, subscribe, and hit the notification bell so you don't miss our updates. Let's explore the world of books together.
Today, we will interpret Capital Returns. This book teaches us how to predict changes in industry profits. Whether you are investing or planning your career, you can find inspiration in this book. Let's start with a true story. In July 1969, a proposal was passed during a congressional hearing in the United States to ban tobacco advertising on television and radio. As a result, after 1971, there were no more tobacco ads on American television and radio. Now, imagine if you were working in the tobacco industry in the United States at that time. Do you think this change would be good or bad for the industry? Many people's initial reaction might be that it's a significant setback. Consumer goods companies can't advertise, so how do they promote their products? Without advertising, it would surely affect sales and profits. However, the reality is that this change led to a significant increase in profits for the U.S. tobacco industry, making it even more prosperous than before. Why did this happen? The logic is not complicated. First, the ban on advertising meant that new brands had no chance to grow, and the market remained dominated by the existing tobacco giants. Second, the tobacco companies saved a considerable amount on marketing expenses, which turned into profits. This way, the existing players in the tobacco industry became long-term winners. Some say that this change transformed the U.S. tobacco business from good business to great business. This story has an interesting twist. The proposal to ban tobacco advertising was actually made by representatives of major tobacco companies. Now, let's switch perspectives. If you were an investor at that time and saw the government enact a law to ban tobacco advertising, what investment decision would you make? If you analyzed it from the demand side, you might think it would negatively impact tobacco sales, prompting you to sell stocks of tobacco giants. However, if you analyzed it from the supply side, you might realize that no new cigarette brands could emerge in the market. In that case, it would be wise to increase your holdings in tobacco giants. The book, Capital Returns, teaches us how to predict changes in industry profits by focusing on the supply side. Many investors and industry analysts often try to predict the future demand for a company or industry, but demand is challenging to predict due to various unpredictable factors. The book suggests that analyzing changes on the supply side of an industry is a better choice for long-term investors because supply is less uncertain and easier to predict. For example, as mentioned earlier with the U.S. tobacco industry, analyzing changes in the competitive landscape on the supply side, no new competitors emerging, led to a situation where a few giants dominated the market. Additionally, observing a significant increase in capital investment and production expansion in an industry could predict increased supply entering the market, affecting prices and profits. In later interpretations, we will discuss more examples in this regard. So, how do we predict changes in industry profits from the supply side? The book introduces a tool called the capital cycle. In the upcoming interpretation, we will focus on explaining how this tool works and how to use it. Now, let's find out who provides us with this tool. In London, there is an asset management company called Marathon, primarily involved in stock fund investments. It's an interesting company with few individual investors, as they exclusively cater to institutional investors and even lack a sales team. Most clients come to them. At the time of the book's publication, they managed assets exceeding $50 billion with an investment team of fewer than 10 people. While $50 billion may not be considered large in the asset management industry, Marathon consistently performed well in the industry for over 30 years since its establishment. Especially during the 1990s Asian financial crisis and the internet bubble around 2000, they managed to achieve commendable results against the market trend. Marathon adheres to the investment philosophy we mentioned earlier, emphasizing supply-side analysis, particularly focusing on observing the capital cycle. This book includes 60 investment reports written by Marathon Asset Management between 2002 and 2015, detailing how they implemented their investment philosophy with various examples. Although the book was published in 2016, it remains relevant and can still provide valuable insights. Today's interpretation is divided into two parts. First, we will discuss how a complete capital cycle operates and present some practical evidence and academic research about the capital cycle. In the second part, we will delve into how to master this tool in practical terms. Alright, let's dive into the first part. Let's elaborate on what a complete capital cycle looks like. We'll use a hypothetical case from the book to illustrate. The protagonist of this story is a U.S. electronic components manufacturer, let's call it Old Ma Industries. Around the early 2000s, the company was doing well, and those who invested in it enjoyed high returns. Many investment analysts were tracking Old Ma Industries stocks, and the majority of them recommended buy or hold. The company's strategic planning department projected strong demand growth for their products in the next 10 years. Consequently, the CEO announced plans to expand production capacity by 50% over the next 3 years. A prominent investment bank approached them to arrange a stock issuance, providing Old Ma with more capital for the expansion. On the day they announced the stock issuance, their stock experienced another surge. At this point, both internal and external stakeholders, including investors and analysts, were confident about Old Ma Industries' future. They believed the industry would rapidly grow, and the profits would be substantial. However, 5 years later, a different scenario unfolded. Old Ma Industries' profits plummeted, survival became challenging, and the stock price dropped by nearly half in the last 12 months. Analysts drastically changed their views, mostly giving sell ratings. What went wrong? Some analysts argued that Old Ma Industries' problem was excessive expansion. Over the past few years, they built many factories, often investing in a new one before recovering the costs of the previous. Moreover, a recently constructed new factory with a total investment of $2.5 billion faced delays and budget overruns. Other analysts contended that the profit decline was due to oversupply in the electronic components market in the last 2 years. About 4 to 5 years ago, the industry's overall profit margins were high. Old Ma, along with many competitors, expanded production capacity, and new low-cost producers entered the industry. Consequently, in the last 2 years, the industry faced oversupply, leading to price reductions and a decline in overall profit margins. Some analysts added that Old Ma Industries faced shrinking market demand. Many countries that once had strong demand for their electronic components significantly expanded domestic production in recent years, some even becoming net exporters, resulting in a substantial drop in demand for Old Ma's products. Now, let's pause here. The book tells us that this story that happened to Old Ma Industries represents the typical first half of a capital cycle. In summary, at the beginning, an industry's profitability is good, attracting a large influx of capital, and the overall industry capacity starts to expand. After some time, the return on capital begins to decline, and capital starts to withdraw. The author notes that many industries have experienced this process over the past 1 or 2 centuries. From the early 20th century North Atlantic cod industry to the 1990s global semiconductor industry, the early 2000s European and American information technology industry, the global shipbuilding industry and real estate market in the 2010s, to commodity industries like global iron ore, coal, zinc, aluminum, and more. All have shown the phenomena described earlier. The rise and fall behind this logic are not complicated. Let's summarize the underlying logic. First, the direct cause of the industry's overall profit decline is oversupply. Why does oversupply occur? It happens because, in good market times, people tend to be overly optimistic about demand. Seeing lucrative profits and high demand, existing companies in the industry increase capital spending, and many new producers enter the industry hoping for a share. After some time, the market's product supply significantly increases. We know that product prices are determined by both supply and demand. If the growth rate of product supply far exceeds the growth rate of demand, it naturally depresses prices, squeezing producers' profit margins. If demand not only fails to grow but also contracts, the situation becomes worse, similar to what happened with Old Ma Industries. Note that what we've discussed so far is the first half of the capital cycle, a process from rise to fall. The second half of the capital cycle is a process from fall to rise. If you've understood the logic we've discussed earlier, you should naturally infer how this second half unfolds. when the industry's profitability deteriorates, the return on capital hits a low, and capital begins to withdraw. Existing players start to shrink their capacity, and some players exit or get acquired, leading to industry consolidation. After some time, industry supply noticeably decreases, paving the way for profit recovery. The industry gradually enters an upswing. This is what happened with the U.S. information technology industry after 2000, the global commodity industry after 2010, and the beer market in Europe and America. Also, during the 2008 global financial crisis, when many countries' stock markets plummeted, it provided an opportunity for low-cost investments. The author observed that the best investment opportunities later on often occurred in industries where capital quickly withdrew and consolidation swiftly progressed after the bubble burst. This process is like a natural disaster in a forest, eliminating many withered or weak trees, leaving the vigorous ones with more space and nutrients to grow more luxuriantly. Alright, at this point, we've covered the entire process of how a capital cycle operates. It's crucial to note that if external forces intervene in the process, the speed and direction of the capital cycle may change. For example, in the mid-20th century, the North Atlantic cod industry faced oversupply, leading to a decline in cod prices. Faced with this situation, fishermen fell into a prisoner's dilemma. Although reducing cod supply was the correct choice from the overall market perspective, from an individual perspective, each fisherman had to catch and sell more fish to offset the losses from falling prices. This led to the outbreak of the cod wars over fishing rights, plunging the industry into a crisis. At this point, the Icelandic government took the initiative. It announced that foreign fishing vessels could not fish near Icelandic waters. Subsequently, Canada, the United States, and other European countries followed suit. The author believes that from the perspective of the capital cycle, this intervention did not have a positive effect. Under normal circumstances, when an industry faces difficulties, capital withdraws, weaker producers exit, and capacity naturally reduces, leading to a price increase. However, government intervention resulted in the cod industry maintaining a state of high supply and low prices for a long time, a prolonged period in the low phase of the capital cycle, which is not conducive to the industry's healthy development. However, some interventions can shorten the low phase. For example, during the 2008 global financial crisis, despite experiencing the bubble and burst process, the real estate markets in the UK and Australia quickly recovered. This was because local governments strictly regulated residential construction to prevent a rapid increase in supply. Hence, they experienced a relatively small bubble and swiftly recovered from the crisis. Alright, let's summarize. We now understand how the capital cycle operates. The underlying logic is a fundamental principle: capital is attracted to businesses with high returns, and once returns fall below the cost of capital, capital exits. However, this book wants to emphasize a critical point: this process is not static but cyclical. Capital entering high-return businesses will, over time, increase capacity and ultimately suppress returns. Conversely, when returns are low, capital exits, capacity decreases, and with time, profits rise again. The operation of the capital cycle is the continuous rotation of this entire process. It might sound understandable, but in practice, not many people can effectively use this tool. This is because it often requires your actions to go against the current, just like your hands moving in the opposite direction to your eyes. What does this mean? For instance, if you see an industry now with extremely strong market demand, supply falling short, and many investments being made to expand production lines to meet demand, is it a good time to invest in the leading companies in this industry? Without understanding the capital cycle, many might think it's the right time to enter. However, from what we've discussed earlier, you should have realized that it's not. Because after some time, the industry is likely to face oversupply, affecting company profits and future stock prices. On the contrary, if an industry, even though currently not very prosperous, has minimal new assets, or even capital is withdrawing, but at the same time, industry concentration is relatively high with only a few major players, then these few companies might be good investment targets. This approach is not only something the book's author summarized from practical observations but has also gained attention from scholars since around 2005. Numerous academic studies have indicated a negative correlation between capital expenditures and investment returns. For example, Nobel laureate in economics Eugene Fama and his colleague Kenneth French observed that companies with fewer investment expansions tend to have higher stock returns. This finding is also known as the investment growth anomaly. Some articles published in top academic journals found that after a company engages in activities such as mergers, new stock issuances, and new loans, expansion behaviors, its stock returns often decrease. Conversely, some activities related to asset contraction, such as stock buybacks and debt reduction, often accompany higher future stock returns. Moreover, research found that the adverse impact of a company's asset expansion on shareholder returns can last for 5 years. Many scholars believe that, compared to some traditional investment analysis indicators such as market capitalization representing company size, price-to-book ratio reflecting investment value, and stock price momentum changes, a company's asset growth can better predict future stock returns. Traditional investment analysis indicators include commonly mentioned metrics such as market capitalization, the price-to-book ratio reflecting investment value, and changes in stock price momentum. Sure, in the first part, we mainly discussed how a complete capital cycle operates, along with some practical evidence and academic research related to the capital cycle. Now, if you are still inclined to believe in the existence of the capital cycle and wish to apply this tool in the future, let's move on to the second part and explore how to master this tool in practice. I'll summarize the relevant content from the book into 3 recommendations. 1. Be wary of linear thinking and cultivate cyclical thinking. 2. Focus on warning signals of cyclical reversal. 3. Stay away from bubbles, even if it means exiting prematurely. After establishing cyclical thinking, the crucial question is how to judge when the cycle will reverse. The key, as discussed earlier, lies in changes in capital expenditures leading to changes in market supply. Reversal often occurs when the market experiences either excess or scarcity in supply. However, the contrast between supply and demand can change suddenly, catching people off guard. To act effectively, it's essential to pay attention to warning signals of cyclical reversal. The book emphasizes that these signals are not limited to specific industries and can provide guidance for actions. The focus is on signals indicating a transition from an upward phase to an oversupply downward phase, which is considered the most dangerous stage of the entire capital cycle. For instance, concentrated IPOs or consecutive stock issuances in a hot industry should raise caution. Monitoring indices that indicate industry concentration, such as the Herfindahl-Hirschman Index, can reveal the competitive landscape. If industry concentration is consistently decreasing, it signals the entry of new competitors, warranting caution. Additionally, the book suggests an interesting observation: when a company begins constructing an extravagant new headquarters, it can be a negative signal. Marathon Asset Management, for instance, tends to view such capital expenditures as excessive or indicative of careless capital usage. Apart from event signals, the book introduces financial signals, like the capex/depreciation ratio rising over the last 3 years or a noticeable decline in the cash conversion rate compared to past averages. The book also mentions other specialized financial indicators like capital expenditures/sales revenue and net debt/EBITDA. While these warning signals are not universally applicable, Marathon's practical experience offers them as reference points when analyzing industries. When concerned that a hot industry might be on the verge of a cyclical reversal, these signals can provide a starting point for analysis. However, merely recognizing warning signals is not enough. Many people acknowledge these signals but hesitate to exit when the industry still appears prosperous. The third recommendation emphasizes the importance of avoiding bubbles, even if it means exiting prematurely. The book cites the 2008 financial crisis as an example, where many analysts and investors expressed concerns years before the crisis unfolded. Some believed in the warnings but chose to stay in the market, seeking short-term gains. The consequences were evident when the bubble burst, and it was too late to exit. In conclusion, the 3 recommendations provide a framework for effectively using the capital cycle tool in practice. Adopting cyclical thinking, focusing on warning signals, and staying away from bubbles, even if it means exiting prematurely, can enhance long-term returns and minimize risks in an environment where the capital cycle is pervasive. Alright, above is the key content I want to share with you from this book. To summarize, the main question addressed by Capital Returns is how to predict changes in an industry's profits. The book suggests that for long-term investors, instead of trying hard to forecast changes in industry demand, it's more effective to focus on the industry's supply side because the uncertainty of supply is much smaller and easier to predict. How to predict changes in industry profits starting from the supply side. The tool provided in the book is called the capital cycle. The underlying logic of the capital cycle is a basic principle. Capital is attracted into high-return businesses, and once returns fall below the cost of capital, capital exits. The key reminder from the book is that this process is not static but cyclical. Capital flows into high-return businesses, increases capacity over time, and eventually suppresses returns. Conversely, when returns are low, capital exits, capacity decreases, and over time, profits rise again. The operation of the capital cycle is the continuous rotation of this entire process. Over the past century, we have seen the presence of the capital cycle in many industries. Moreover, since 2005, there has been academic research observing the situations described in the capital cycle. For those interested in the capital cycle and hoping to use this tool in the future, the second part of today's interpretation also provides 3 recommendations. 1. Beware of linear thinking and cultivate cyclical thinking. 2. Focus on warning signals of cyclical reversal. 3. Stay away from bubbles, even if it means exiting prematurely. In addition to the content discussed today, the book also delves into real investment cases experienced by Marathon Asset Management, including more in-depth cyclical analysis approaches. Furthermore, the book discusses how the capital allocation ability of company management affects long-term capital returns and some situations where the capital cycle malfunctions. If you're interested, I recommend opening the original book for further reading. Alright, we'll wrap up our discussion of this book today. You can click on the transcript below the audio to view the full text and mind map of the book. Feel free to click the share button in the upper right corner to share this book for free with your friends. Congratulations, you've completed another book. Please subscribe to the Tim Booker channel, like, and share this valuable knowledge with your friends. Let's combine wisdom and practice, achieve our financial goals, and create a better future together. Thank you, everyone, goodbye.